Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, July 10th, 2026. We're Elena and Marcus.
Right. And if you look at the headlines this morning, you might assume the global markets are just in a complete state of panic.
I mean, we have a collapsing ceasefire in the Middle East, a central bank warning about highly persistent inflation, and massive shifts in global currency positioning.
Exactly. Yet if you look at your equity portfolio today, you are likely seeing green.
Yeah, so today we are unpacking the three major themes driving this glaring contradiction. First, we're looking at why front-end interest rates are aggressively backing up following the Federal Reserve's latest policy report and how equities are managing to completely ignore that pressure.
Right.
Second, we're breaking down a historic $26.5 billion U.S. debut for SK Hynix. This is cementing a massive structural shift in the tech sector toward what is being called the ALO theme. That's heavy assets, low obsolescence.
This huge shift.
And finally, we need to address a dangerous disconnect between the physical reality of the Strait of Hormuz and the extreme complacency currently priced into the options market. We are going to parse the institutional flows and give you the mechanics behind exactly how these shifts impact the broader economic regime.
Moving to today's data.
So the overarching narrative jumping out from today's proprietary updates is this palpable growing tension between sticky inflation and the interest rate curve.
Right, because the short end of the U.S. Treasury curve cheapened noticeably today, didn't it?
Correct. We saw the two-year yield rise 2.9 basis points to 4.209%, while the five-year yield rose 2.1 basis points.
But conversely, the long end of the curve caught a mild bid. Like the 30-year yield actually fell 0.5 basis points, closing at 5.071%.
Yeah, and that divergence is key.
Well, let's apply our first principles rule right here, because the terminology around bond yields often alienates regular investors, but understanding it is critical to reading the market's pulse.
When we look at this specific divergent movement from today's data deck, this bear flattening at the front of the curve where short-term yields go up and the bull flattening at the back end where long-term yields go down. Could you walk us through the basic mechanics? What is the bond market actually trying to signal to you and me?
Correct. Let's break down the mechanics. The yield curve is essentially a timeline of the cost of money.
Okay.
When the two-year yield rises, the market is sending a message about the immediate future. It means bond traders believe the central bank is going to be forced to keep borrowing costs higher right now, in the short term, to fight off inflation that simply refuses to cool down.
Got it. But the long end is doing the opposite.
Right. When the 30-year yield falls at the exact same time, it sends a much darker message about the distant future. It signals that investors believe this aggressively tight monetary policy in the short term will eventually constrain the broader economy.
So it basically acts as a chokehold on long-term economic growth.
Exactly. So synthesizing those two movements, the market is repricing immediate inflation risk higher while simultaneously pricing in a long-term expectation of severe economic deceleration.
And when we dig into our latest run to find the catalyst for that immediate inflation risk, it points directly to the Federal Reserve's July monetary policy report.
It does.
The Fed explicitly reaffirmed that inflation remains stubbornly elevated. But what caught my attention were the specific drivers they cited.
Right, the geopolitics.
Yeah, they pointed to tariffs and the ongoing Iran war, which are standard geopolitical pressures. But they also introduced a relatively new structural driver, which is AI-related energy demand.
Yeah, that's a massive shift.
The sheer electrical power required to run next-generation data centers is now officially recognized as a macroeconomic inflationary pressure.
It is. I mean, the energy intensity of artificial intelligence has officially graduated from a theoretical corporate talking point to a literal central bank policy constraint.
Because these hyperscale data centers require dedicated substations, right?
Right, and they draw immense loads from the municipal power grids. That drives up utility costs across the board. And while the U.S. yield curve is contorting to digest this domestic inflation stickiness, we are witnessing a sharp policy divergence internationally.
Look at in the UK.
Yeah, in the UK today, gilt yields fell. Institutional consensus has severely pared back Bank of England rate hike bets. They're now pricing in just 22 basis points of tightening by November.
Meanwhile, look at Japan. The Japanese yen remains exceptionally weak against the dollar, pushing the USD-JPY exchange rate to 161.68 today.
It's a huge gap.
Right, and that specific divergence in central bank policy, the Fed's staying tight while global peers loosen, is driving massive, heavy capital flows across borders.
And we can see that in the futures data.
Yeah, our daily desk data shows that non-dealer U.S. dollar positioning in foreign exchange futures just hit a 7-year high, sitting at a massive $13 billion net long position. The global market is overwhelmingly betting on U.S. dollar strength entirely because the Fed is being forced to hold rates higher for longer than anyone else.
On that point, basic financial gravity suggests that higher front-end interest rates combined with a historically strong dollar should act as an anchor on the stock market.
You would think so.
Right, because a strong dollar hurts multinational corporate earnings abroad, and high short-term rates offer a risk-free alternative to equities.
Yet, the equity market today effectively laughed off the rate headwind.
It really did. The S&P 500 added 0.42% today, closing at 7,575.39. And what really stands out in today's proprietary updates is the breadth of that advance.
The equal weight index.
Yes, when we look at the equal weight S&P 500, the RSP, it nearly matched the performance of the traditional cap-weighted index. For context, the traditional S&P 500 is heavily skewed by the massive valuations of a few tech giants. So when the equal weight index, which treats the smallest company in the S&P the exact same as the largest, moves in tandem with the cap-weighted index, it tells you this wasn't just a handful of mega-cap tech stocks dragging the market higher.
It was a broad, healthy advance across multiple sectors of the economy.
We also tracked significant shifts in institutional positioning beneath the surface of that rally. Hedge funds actively re-engaged today.
As net buyers.
They were net buyers of U.S. equities, but the mechanics behind that buying are crucial. It was primarily driven by short covers in single stocks. In institutional finance, this is known as degrossing.
Right.
When a hedge fund bets against a stock by shorting it and they decide to exit that position, they are forced to buy the stock back in the open market. Our daily desk data marks today's short covering as the largest degrossing activity we have seen in 3 months.
And that mechanical forced buying provides an artificial lift to equity prices.
Correct, but it certainly wasn't indiscriminate buying. There is a distinct tactical rotation occurring. The pure momentum basket, which tracks the stocks that have been going up the fastest, actually sold off by over 20 percentage points today.
So institutional capital is deliberately rotating out of pure momentum and into a very specific emerging theme.
Yeah, and the most dominant of those new themes is what institutional desks are calling halo-heavy assets, low obsolescence.
The infrastructure build-out.
Exactly. We are watching the hyperscalers drastically revise their 2026 to 2028 capital expenditures upward. Amazon is projected to spend roughly $827 billion in cumulative capex over that period.
Wow. Wait, I shouldn't say that. Those numbers are staggering.
Google is projected at roughly $790 billion. We are witnessing a transition where these tech giants are abandoning the capital-light software model of the last decade and moving toward a massively capital-intensive infrastructure model.
To contextualize those numbers, that is sovereign-level infrastructure spending.
It really is. They're physically building out data centers, securing dedicated power grids, and laying thousands of miles of physical fiber optic cable.
When I look at those capex figures, it directly parallels the construction of the Transcontinental Railroad in the 19th century.
That's a good comparison.
Think about the mechanics of that era. You had this highly capital-intensive phase where immense amounts of physical infrastructure had to be laid down. Companies were blasting through solid granite mountains and laying thousands of miles of iron tracks.
And that required staggering amounts of capital long before the real commercial transport of goods could even begin.
That is exactly what we are seeing with this halo capex shift. Amazon and Google aren't just writing software anymore. They are physically building the heavy iron tracks for the next decade of the digital economy.
Understood. And the broader market is currently rewarding the suppliers of that infrastructure build-out. Look at the single stock specifics from today's data deck. SK Hynix dominated the session.
The memory chip maker.
Right, which typically trades on the KOSPI, but they executed a record $26.5 billion US ADR debut, and the stock closed up 12.8% on its first day of trading.
And for investors unfamiliar with the mechanics, an ADR is an American Depositary Receipt. It is a certificate issued by a U.S. bank that represents shares in a foreign stock, right?
Correct, allowing U.S. investors to trade foreign equities locally on American exchanges without dealing with cross-border currency conversions.
And that massive $26.5 billion debut completely validated the insatiable demand for high-bandwidth memory chips. These specific chips, are the physical bottlenecks for AI data centers.
Yeah, the success of the SK Hynix ADR sent ripples through the entire semiconductor supply chain. NVIDIA was lifted 4.0% purely on the back of that validation.
Meta also jumped 6.0% today, following institutional consensus reports that highlighted their massive stockpile of GPUs, giving them a significant frontier AI compute advantage.
The market is pricing in the reality that whoever possesses the most physical compute power, the heaviest assets, will decisively win the next business cycle.
But while the AI infrastructure trade thrived, we tracked defensive rotations in other sectors too.
It did. Materials tracked by the XLB ETF led the broader sectors, up 1.30%, alongside consumer staples, the XLP, up 1.10%.
And on the downside,
Healthcare, the XLV ETF, lagged heavily, dropping 0.80%. That drop was heavily dragged down by Moderna, which plunged 10.8% today. Delta Airlines was another notable laggard. They actually beat their earnings per share estimates for the quarter, but the stock fell 2.6% regardless.
Well, I want to pause on the broader sector flows before we look deeper at Delta's specific headwinds. Our daily desk data shows that financials saw aggressive net selling today, right ahead of their second quarter earnings releases.
They did.
This occurred despite very strong institutional expectations for their actual earnings reports. Applying our first principles rule again, could you explain the mechanics behind this? Why are institutions aggressively dumping bank stocks right before the banks are expected to announce strong quarterly profits?
It is a classic sell the news setup, deeply intertwined with valuation concerns and the yield curve mechanics we discussed earlier.
Okay, how so?
Institutional investors are looking squarely at the 10-year, 2-year yield curve inversion. Banks operate on a very simple fundamental model. They borrow short-term money in the form of customer deposits, and they lend out long-term money in the form of mortgages and corporate loans.
Right.
When the yield curve is inverted, short-term deposit rates are higher than long-term lending rates. This severely compresses their net interest margin.
Makes sense.
So even if the immediate backward-looking earnings print is strong, institutions know that forward-looking profitability is under immense pressure in a higher-for-longer rate environment.
They're getting ahead of it.
Exactly. Institutions are proactively de-risking their financials exposure, locking in their profits now before management teams are forced to provide cautious, defensive forward guidance.
Indeed. And that theme of cautious forward guidance ties directly into the input cost pressures we saw weighing on Delta Airlines today.
Yes, the fuel costs.
Right, Delta beat their earnings estimates, but the stock fell 2.6% because record fuel costs are eating into their future profitability guidance. Moving to today's data on commodities and hard assets, those input costs are being entirely driven by the geopolitical realities threatening global supply chains.
Specifically around the Strait of Hormuz.
Right.
Oil settled slightly lower today, with WTI crude at $71.51 a barrel and Brent crude at $75.98. However, despite today's slight pullback, crude remains up roughly 4% on the week.
And the overarching catalyst here is the acute U.S.-Iran tension.
Correct. The previously negotiated ceasefire was formally declared over today. The only thing preventing a massive immediate price spike is the continuation of back-channel technical diplomatic talks.
But the physical supply reality is already severely impacted, regardless of the ongoing talks. According to our latest run, Persian Gulf oil exports have plummeted to just 71% of their normal operating levels.
It's a huge drop.
Yeah, we are down to 16.5 million barrels per day flowing out of the Gulf following the recent crude tanker attacks. And the second-order effects of this bottleneck are starting to hit sectors far beyond energy.
Like agriculture.
Exactly. Mosaic, the major fertilizer producer, jumped 3.7% today. Why? Because the raw materials and fertilizer flows that typically transit through the Persian Gulf have slowed to a trickle.
And that logistical bottleneck is directly threatening the upcoming South American agricultural planting seasons.
Correct. The market is slowly realizing that a disrupted Strait of Hormuz doesn't just mean more expensive gasoline at the pump.
No, it means significantly more expensive food globally in 6 months. That underlying supply chain anxiety is also reflecting in precious metals.
Right. Gold is holding near record territory, closing today at $4,119.93 per ounce. Institutional investors are using hard assets to hedge their portfolios against the possibility of a total supply chain breakdown. But let me challenge the pricing logic here, because there is a glaring discrepancy in today's data deck.
What's that?
Well, if Persian Gulf oil exports are fundamentally down 29% And the ceasefire has officially been declared over. Why isn't oil spiking much higher? Why is WTI sitting quietly at $71 a barrel when the physical market is bleeding supply?
It is a vital question, and the answer lies in two specific mitigating factors detailed in today's proprietary updates.
Okay.
First, we have to look at the physical supply buffer. The United Arab Emirates pumped a record 4.1 million barrels per day in June.
So they're making up for it.
Right. That surge in production is actively offsetting a significant portion of the immediate supply risk coming out of the broader Gulf region. Second, we have to examine institutional positioning in the paper markets.
The futures market.
Yes, speculative hedge funds have actually cut their net long oil positions to a 6-month low. The speculative community simply is not positioned for a sustained breakout price spike in crude right now.
So they don't believe the disruption will last.
Basically, they are fundamentally trusting that OPEC possesses enough spare production capacity to bridge the gap if the Hormuz situation deteriorates further.
So synthesizing all of these moving parts, the front-end interest rates backing up, the massive capital expenditure lifting AI equities, and the surprisingly contained commodity markets. What does this data tell us about the current economic regime?
Our daily desk data suggests we are currently operating in a very specific soft landing plus AI growth regime.
Right.
The sheer momentum of technology earnings driven by that heavy asset ALO theme is powerful enough to override both geopolitical supply threats and restrictive interest rate headwinds.
However, when we connect the dots across the different asset classes, there are subtle structural fractures in that optimistic narrative, aren't there?
Absolutely. I mean, yes, there are. Credit markets, for instance, are actively refusing to fully confirm the equity rally. High-yield corporate bond ETFs, specifically HYG and JNK, were flat to down today.
And these ETFs track debt issued by companies with lower credit ratings, right?
Correct. Specifically, CCC and BB rated corporate bonds. Credit investors are highly sensitive to balance sheet health and the cost of debt servicing.
So their reluctance to bid up high-yield debt today, even while stocks rise, is a subtle but critical divergence from the S&P 500's steady climb.
The credit market is historically considered the smart money, and right now they are sitting on their hands demanding higher yields for risk while equity investors charge forward blindly.
But the most shocking cross-asset signal from today's data deck isn't in the credit markets, it is in volatility.
The VIX.
Right, the VIX, the index which tracks expected market volatility based on S&P 500 options pricing, actually compressed by 5.1% today, dropping down to 15.03.
That is an astonishingly low level of implied volatility for the current macroeconomic environment. You have a situation where the U.S. just officially declared a Middle East ceasefire is over, and physical Gulf oil exports are quantifiably down 29%.
A VIX at 15 implies the market expects calm, steady, predictable trading conditions ahead. And the situation gets significantly more complicated when you factor in the geopolitical news that crossed the desk just after hours today. The U.S. formally demanded that Iran publicly state the Strait of Hormuz remains open to commercial transit.
If we synthesize that specific diplomatic escalation with the VIX sitting at 15.03, it demonstrates extreme, almost willful complacency in the options market.
The market is pricing in a 100% probability of a contained diplomatic resolution.
But if a true, sustained physical closure of the Strait of Hormuz actually occurs, it would not be a localized issue. It would be a regime-changing event for the entire global economy.
Because right now, the underlying logic of the market relies on an environment where equities can rise alongside oil, assuming the growth from AI outpaces the drag of inflation. But if Hormuz actually closes, that entire mathematical correlation violently flips.
Exactly. A physical closure triggers an immediate stagflationary shock. The mechanics are brutal oil spikes aggressively, global supply chains freeze, and inflation reaccelerates rapidly.
And the Fed would be stuck.
Completely. The central bank would be entirely handcuffed. They would be unable to cut interest rates to support the slowing economy because they would be forced to fight the surging energy inflation.
So the traditionally positive correlation between equities and commodities would invert.
Yes. You would see an aggressive, simultaneous sell-off in both stocks and bonds, effectively breaking the traditional 60-40 portfolio strategy. That specific, catastrophic tail risk is completely unpriced by the current implied volatility levels hovering at 15.
It is an incredibly delicate balance. So to quickly recap our core takeaways from today's briefing, We are seeing front-end Treasury yields rising sharply as the Fed acknowledges sticky structural inflation drivers like AI energy demand.
Right.
Despite that intense rate pressure, the broad equity market is marching higher, powered by the massive halo capital expenditure theme, which was perfectly illustrated by SK Hynix's historic $26.5 billion ADR debut.
Very true.
And finally, despite severe, tangible supply chain threats in the Strait of Hormuz, the VIX is signaling deep market complacency, leaving portfolios entirely exposed to an unpriced stagflationary shock.
The structural shift in technology capex is clearly providing a powerful growth offset for the moment, but the severe disconnect between the options market pricing and the physical geopolitical reality is the paramount vulnerability to monitor heading into next week.
And as you review your own portfolio allocations this weekend, I want you to consider the railroad analogy we discussed today. If the physical tracks of the new AI economy require sovereign-level capital to build, hundreds of billions of dollars in heavy assets, what happens to the broader market if the cost of borrowing that capital suddenly breaks out of its current constraints?
That's the billion-dollar question.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Congratulations to France and Spain for being the first World Cup semifinalists. That's going to be a great match. Let's see who comes out from the other side of the bracket.